As a property manager, I'm sure you understand the importance of maximizing cash flow for your clients. One way to achieve this is by having landlords claim depreciation on their investment properties. Unfortunately, we found that so many investors are leaving thousands of dollars on the table because they're not utilizing this benefit. And that's often because they think their property is too old and doesn't qualify. But that's not the case, because the ATO will allow all landlords to potentially claim hundreds of thousands of dollars in depreciation if the property was built at least after 1987, or if the property has been renovated or improved by any previous owners after 1992. So even if you're the 5th or 10th owner of the investment property, as long as the above scenarios apply to you, you're entitled to claim depreciation for the remaining years left in the property. It's also worth mentioning that the depreciation is split over 40 equal years. So there is no disadvantage in claiming building depreciation for the property owners that are either the first or the last within the 40 years. And if you're unsure about when the landlord's property was built, a registered quantity surveyor can estimate the year of construction on both the building and the renovations. So now that we understand the scope of what can be claimed, let's get into a case study of the actual monetary benefits to a landlord. Meet Sarah, who purchased a 10-year-old house for $646,000 in June 2020 and immediately rented it out for $470 per week, generating $24,440 in rental income per year. To cover expenses such as interest repayments, management fees, council rates, and maintenance costs, she was spending $35,409 annually. Because the property is older, the fitted plant and equipment assets are considered second-hand, meaning Sarah can't claim deductions for the depreciation on these assets. But she can claim depreciation on the property's capital works, which are the property's structural element. Without claiming depreciation, Sarah would be running at a loss of $10,969 annually. Now, this isn't such a bad thing because she can reduce her taxable income by that loss. So, with a marginal tax rate of 37%, she could reduce her taxable income by $4,059, bringing the annual costs of her investment property down to $6,910, a weekly loss of $133. However, by taking advantage of the ATO's tax breaks and making a depreciation claim, Sarah could claim $6,300 in depreciation in her first year, which she could add to her net loss, meaning she could claim an even bigger refund from the ATO. So, with a depreciation claim, Sarah would be running at a loss of $17,269, decreasing her taxable income by $6,390. As a property manager, you know that the rent increase conversation can be tricky, especially in the current market, but you understand that your landlords have to make ends meet. Claiming depreciation is an alternative way to help boost cash flow. So, as a property manager, it's essential to inform your clients about the benefits of claiming depreciation on their investment properties. Tax can provide a free estimate and prepare a depreciation schedule valid for up to 40 years. With a simple phone call or an online form, you can get the ball rolling and receive the report for your clients within 5 to 10 business days. If you'd like to get started, head over to our website at duotax.com.au and drop down the Partners tab and click on Become a Partner to provide your details for one of us to reach out to you.